Most people in their 30s are sitting on the sidelines right now waiting for rates to drop, waiting for the market to dip, waiting for a bigger paycheck. And that wait is costing them way more than they realize. Here's the math. $5 a day at 25 grows to six figures by 55. Not with some complicated strategy. Just by starting. So let's talk about the exact system to start with $1 and scale it as your income grows. The cost of waiting, why 2026 is the right time. There's a trap a lot of people fall into right now, and it sounds completely reasonable. It goes something like this: I'll start investing once rates come down a little. Or once the market pulls back. Or once I'm making a bit more. That thinking feels responsible. It feels like you're being smart about timing. But here's the problem. Rates have been about to drop for 2 years. And while you've been waiting, inflation has been quietly doing its thing. Think about this. If you have $1,000 sitting in a checking account right now, in 10 years that money is worth roughly $740. Not because someone took it. Just because inflation erodes purchasing power at about 3% a year. So doing nothing isn't safe. It's actually a guaranteed loss. Now flip it. That same $1,000 invested in a broad market index fund grows to almost $2,000 in 10 years at a 7% average annual return. That's the historical average return of the US stock market, adjusted for inflation. So you go from losing $260 to gaining $1,000, just by moving the money from a checking account into an investment account. That's not a small difference. That's the entire game. And here's what makes this especially relevant if you're between 25 and 45. You're in the window where compounding time does the heaviest lifting. Not perfect conditions. Not a bigger starting balance. Time. Every year you wait isn't a neutral decision. It's a year of compounding you'll never get back. The opportunity cost is the real risk here, not market volatility. Most people think of risk as the market dropping 20%. But a 20% drop recovers. Missing 5 years of compounding in your 30s doesn't. That gap follows you all the way to retirement. So the first move in 2026 isn't finding the right stock or waiting for the Fed to move. It's opening the right account and putting something in it. Anything. Opening the right account and picking your first investment. 3 brokerages worth knowing about for beginners right now. First is Fidelity. No account minimum, no fees to open. You can start with literally $1. Second is Vanguard. They have a minimum, but they'll waive it if you agree to set up automatic investing, which you're going to do anyway. Third is Charles Schwab. Same deal. They waive the $1,000 minimum if you set up a $100 monthly automatic contribution. Honestly, the differences between these 3 are pretty small. Don't spend 3 weeks comparing features and reading forums. Pick one and move. The cost of not starting is much higher than the cost of picking the slightly imperfect brokerage. Now, account type matters more than most people realize. For the majority of people in the 25 to 45 range, the default starting point is a Roth IRA. Here's why it's so good. You contribute post-tax money, meaning you already paid income tax on it, but from that point forward, everything grows tax-free. The gains, the dividends, all of it. And when you pull it out in retirement, you owe 0 taxes. In 2026, the contribution limit is $7,500 a year, which works out to $625 a month. If you hit the income limit for a Roth IRA, the next move is a standard taxable brokerage account. No income restrictions, no contribution caps, invest as much as you want. Once the account is open, you need to actually buy something inside it. And this is where a lot of people overthink it. They picture stock charts and earnings reports and that feeling of needing to pick a winner. Here's what the data actually says. More than 75% of professional fund managers fail to beat the market over a 10-year period. So the people doing this full-time, with research teams and Bloomberg terminals, mostly lose to the index. Which means you don't need to pick stocks. You just need to buy the market. Index funds do exactly that. They hold a basket of the biggest companies in the market automatically, and because there's no active management, the fees are almost nothing. Fees compound just like returns do, so small differences add up to tens of thousands of dollars over 30 years. 3 specific funds worth knowing. Fidelity FZROX has a 0% expense ratio and no minimum. You can start with $1. Schwab SWTSX charges 0.03% with no minimum. Vanguard VTSAX is 0.04% with a $3,000 minimum that gets waived if you set up automatic investing. Any one of these works. The point isn't finding the perfect fund. It's getting money into a low-cost index and letting it sit. Account open, fund picked. Now comes the part that actually builds wealth over time. Automating and scaling the system. Here's the move that separates people who actually build wealth from people who just think about it. Automation. Once you set a recurring transfer from your checking account into your investment account, the decision is already made. You don't have to remember, you don't have to feel motivated, you don't have to time anything. The money moves on its own and it buys more of the index fund automatically every single month. Start wherever you can. Even $50 a month becomes $55,000 over 30 years at a 7% average return. That's not a typo. $50 a month, left alone, compounds into $55,000. Most people will increase that amount over time as their income grows, but the habit of automating it is what makes that possible. Now here's the one annual decision that's worth more than almost anything else you'll do with your money. Every December, increase your contribution by 1%. That's it. Just 1%. Here's what that actually means in real dollars. Two people, same $80,000 salary, both start investing at 30, both retire at 65. Person A invests a flat 5% every year and gets a 7% return. They retire with $553,000. Person B starts at the same 5%, bumps it by 1% every December until they hit 15%, then holds it there. Same 7% return. They retire with $1.4 million. That one annual decision is worth about $845,000. One click, once a year. So once automation is running, here's the order you want to scale it. First, make sure you're capturing your full employer 401k match. If your employer matches 5%, that's an instant 100% return on that money. Nothing in the market touches that. Second, pay off any high-interest credit card debt. At 26.99% interest, carrying a balance is a guaranteed loss that no index fund can outrun. Third, max your Roth IRA, that's $7,500 in 2026. Fourth, go back and max your 401k, the limit is $24,500 this year. And fifth, if you've done all of that and still have money to deploy, open a taxable brokerage account. No limits, no caps, no income restrictions. Most people don't need to reach the top rung to build serious wealth. You just need to know the sequence and move up it methodically. And the reason starting now matters more than starting with more comes down to one number. Warren Buffett made 98% of his net worth after age 60. Compounding is backloaded. The seeds you plant in your 30s are the ones that produce the harvest. One last thing, connect your investing to something specific. Not retirement or the future. A real goal. A place you want to live, a trip you want to take, a version of your life you actually want. That's what keeps the system running when motivation dips. The best time to start was yesterday. The second best time is right now. If you want more tips and insights into budgeting, saving, and investing, make sure to hit the subscribe button on your way out.